I want you to close your eyes for a second. Picture a dusty, unpaved road. It could be anywhere. The interior of Brazil, the plains of Ukraine, or a rural stretch in Ghana.
Hmm.
It's hot. The air smells like diesel and dry earth. A massive 18-wheeler rumbles past you, kicking up a cloud of dust so thick you can almost taste it.
Okay, I'm there.
The truck is loaded to the absolute brim with wheat, and it's heading toward a port hundreds of miles away. Now, if I tapped you on the shoulder and asked, what are you looking at? Good. What would you say?
Well, most people would say that's agriculture. Or maybe if they're feeling a bit more technical, they'd say that's logistics. You're seeing food move from a farm to a table. It's the most fundamental physical transaction in human history.
Exactly. That's what I see. I see bread, I see pasta, I see the physical stuff of life. But we're here today because we've both been reading the Trade and Development Report 2025, specifically Chapter 3. And the authors of that report, well, they see something completely different.
They really do.
When they look at that truck, they don't see wheat. They don't even see a vehicle. They see a financial instrument on wheels.
It is a striking image, isn't it? But the more you dig into the report, the more you realize how chillingly accurate it is. We're doing a deep dive today into what they call the financial architecture of global food trading.
And I know. That sounds like the title of a lecture you'd sleep through in grad school.
It sounds incredibly dry. I'll admit, when I first opened the file, I was expecting to analyze harvest yields, fertilizer costs, maybe some climate change data.
Me too. I was gearing up for a very standard trade report. But when I actually got into the weeds of this chapter, I realized this isn't a trade report. It's a financial thriller.
It really is.
It's about a massive, completely invisible shift in the global economy that has turned the people who feed us into something else.
Something else is the polite way to put it. The report argues that we're talking about how the companies that move our food, the entities we think of as traders or even giant grocers, have quietly transformed into some of the world's largest and, this is the key part, unregulated shadow banks.
And this is so important for you listening to understand. We aren't just talking about why your loaf of bread costs a bit more this year. We are talking about the very security of the global food supply.
Yeah.
The report makes this compelling case that the mechanism feeding the world is no longer driven just by supply and demand. It's driven by structured finance, by securitization, and by something the report ominously calls liquidity illusions.
The scale of this is just hard to overstate. Like I said, I was expecting agriculture, but instead I found myself reading about embedded derivatives, synthetic banking, and volatility arbitrage. If you stripped the word wheat or soy out of this report, you would swear you were reading a post-mortem of Wall Street in 2008.
That comparison to 2008 kept popping up for me too. It feels like we're watching a sequel to the financial crisis, but this time the asset class isn't subprime mortgages in Florida, it's the food on our plates.
And that is the core tension, isn't it? We are witnessing the complete financialization of the most basic human necessity. I mean, unlike the housing market, you can't just decide not to participate in the food market.
You have to eat.
You have to eat.
So we have a lot to unpack here. We need to figure out who these players are, how they stopped being simple merchants and somehow started being bankers, and what happens if this whole house of cards decides to wobble.
Right.
But before we get to the really scary stuff, we need to understand the cast of characters. Who are we actually talking about here?
In the industry, they're legendary. They are the invisible giants. But to the average person, they're often total unknowns, which is part of their power. For decades, we've referred to them by a simple acronym, the ABCD giants.
ABCD. It sounds so innocent, like something from grade school. But these companies are anything but small.
Far from it. The acronym stands for Archer Daniels Midland, which is ADM, then Bunge, Cargill, and Louis Dreyfus. These four companies have, for over a century, just completely dominated the global grain trade.
And when you say dominated, what kind of scale are we talking about?
Think about it this way. If you ate bread, pasta, a tortilla, or, anything containing soy or corn syrup today, it is almost a statistical certainty that it passed through the hands of one of these four companies.
So they're the gatekeepers.
They are more than that. They're the infrastructure itself. They own the grain silos, the port terminals, the processing plants, the shipping fleets. Historically, their business model was incredibly straightforward. We call it the cost-plus model.
Right, the classic merchant model. I buy wheat from a farmer in Kansas for, say, $5 a bushel. It costs me $1 to ship it to a baker in France. I sell it to the baker for $7.
And you make $1.
I make $1 of profit. Simple, clean, Physical trade.
Precisely. You make money on the physical movement and processing of the goods. You buy low, you sell high, and you capture that margin in the middle. But the industry has evolved. That old ABCD club has expanded. We now talk about the ABCD Plus group.
Okay, so who are the new kids on the block? Who's in the plus?
It's not just the Western giants anymore. You have KioFCO, which is the massive state-owned Chinese trader. They're a behemoth. You have Glencore, which a lot of people know from metals and mining, but they are absolutely huge in agriculture now.
Right.
And then you have Wilmar and Olam, both based out of Singapore. These are the new titans. And while they all still own the ships and the silos, the Trade and Development Report 2025 drops a statistic that just completely shatters the idea that they are still just merchants.
I think I know the number you're about to drop. I actually had to read it twice. I highlighted it in neon yellow in my copy.
It is the smoking gun of the entire report. I mean, It is the central finding. The authors found that since 2018, for these major food trading companies, income from financial intermediation.
So acting like a bank.
Yeah. Yes. Acting like a bank has consistently accounted for between 74 and 76% of their total revenues.
Okay, stop. We need to let that breathe for a second. 3/4 of their revenue.
Yes, 76%. Let that sink in.
So if I am a shareholder in ADM or Bungie, or if I'm just an analyst looking at their balance sheet, I'm not looking at an agriculture company. I'm looking at a bank that just happens to own some grain elevators as a side business.
You're looking at a hedge fund with a side hustle in logistics. The physical food, the actual wheat and corn, has become almost a secondary asset. Or maybe more accurately, the physical food is just the collateral for the real business.
And the real business is finance.
The real business is finance.
That is such a fundamental shift in identity. It reminds me of how people say McDonald's isn't really a burger company, it's a real estate company.
Yeah.
But this feels even more extreme somehow.
It is. And to understand the magnitude, you just have to look at the profit numbers. In 2024, the report states that the gross profits for the industry were around $95 billion.
$95 billion.
And that is 2.5 times higher than their average profits between 2011 and 2019.
But wait a minute. That doesn't quite add up with the story we hear on the news. We know food prices spiked like crazy in 2022 because of the war in Ukraine and all the supply chain issues. But prices have come down since then.
They have.
So if they were just simple merchants using that old cost-plus model, shouldn't their profits have dropped alongside the commodity prices?
That is the logical assumption, 100%. In a traditional model, lower prices often mean tighter margins. But here, profits stayed near record highs even as the price of wheat and corn retreated from their peaks.
And that's the proof.
That is the proof that they are no longer relying on the price of the commodity itself. They are profiting from volatility, they're profiting from providing financial services. It's a completely different game.
Which is why the report explicitly classifies them as non-bank financial institutions, or NBFIs.
Which is the polite, regulatory term for shadow banks. They have become these critical, systemically important nodes in the global financial network. They connect the big global banks, the capital markets, and the producers on the ground. They've become the bankers for the entire food system.
Okay, so we've established the what. They are, for all intents and purposes, bankers now. But this didn't happen in a vacuum, right? You don't just wake up one morning and decide to fundamentally alter a century-old business model. What drove this change? Was it just greed? Or was there some kind of structural reason?
There's always greed, sure, that's a constant. But the primary driver here, and this is what's so fascinating, was actually regulation.
Regulation did this.
In a way, yes. The law of unintended consequences. To understand the why, we have to go all the way back to the global financial crisis of 2008.
Of course. Everything always comes back to 2008, doesn't it?
It really was the pivot point for the modern economy. After the crash, global regulators got together in Basel, Switzerland, and they said, never again. They were determined to stop banks from taking these crazy risks with depositor money. So they introduced a new, much stricter set of regulations known as Basel III.
Okay, I've heard of Basel III, but usually in the context of, super boring banking compliance reports. How on earth does that affect a grain trader in Iowa?
Well, Basel III required traditional banks, your JP Morgans, your HSBCs, your Citigroups, to hold significantly more capital against any risks on their books.
Right.
So for every dollar they lent out, they had to keep a much bigger safety cushion of their own money in the vault, just in case the loan went bad.
Okay, that sounds like a good idea on its face. Safer banks. What's the problem?
It is a good idea for financial stability, but it had a massive unintended consequence for global trade. There is a specific type of banking called trade finance, and historically, it's the most boring, unsexy business in the world. It's mostly about issuing something called a letter of credit.
Okay, walk us through that. What does a letter of credit actually do?
Imagine you're a farmer in Brazil and you want to sell a shipload of soy to a buyer in Vietnam. You don't know this buyer from Adam. You're afraid that if you ship the soy, he just won't pay.
And the buyer in Vietnam is afraid that if he pays me, I won't ship the soy.
It's a classic trust gap, a standoff. So historically, a bank steps into the middle. The buyer's bank issues a letter of credit. It's a legal document that says, if the farmer in Brazil ships the soy and provides the correct documents proving it, the bank guarantees the payment.
Ah, so the bank acts as the trust layer. It greases the wheels of global trade.
It's the grease. But under Basel III, these letters of credit were suddenly treated as much riskier exposures. Banks had to set aside a lot of their own capital to back them up. And all of a sudden, this very low-margin, high-volume business of financing trade became incredibly expensive and unattractive for the big banks.
So a risk officer at a big bank looked at a deal to move corn from Argentina to, say, Egypt, and said, you know what? Not worth the headache. Too much paperwork, too much capital requirement for the tiny profit we'll make.
Exactly. They started a process of de-risking. That was the buzzword. They pulled back from financing these specific individual trade deals, especially in developing countries or with smaller players. If you were a mid-sized coffee producer in Nigeria or a flour mill in Indonesia, the big global banks essentially stopped taking your calls.
But the world still needs to eat. The demand for food didn't go away. The soy still had to get from Brazil to Vietnam.
Nature abhors a vacuum, and so does finance. A massive opening was created in the market. The banks stopped lending directly to the specific trade transaction. Instead, they looked at the ABCDs, these massive, stable corporate giants with stellar credit ratings, and they said, look, we won't lend to the little guy in Vietnam, that's too risky now, but we will lend a ton of money to you.
Ah, I see. So the bank writes a single check for, say, $5 billion to ADM or Cargill.
A huge, unsecured corporate credit line. And ADM or Cargill, who are not regulated as banks and therefore do not have those strict Basel III capital constraints.
They're not subject to the same rules.
Not at all. They take that chip credit and they step right into the gap left by the banks. They start lending it out to their suppliers and their buyers all over the world.
So they became the middleman for the money, not just the middleman for the grain.
That's it. It's what the industry calls synthetic banking. The trader already controls the physical flow of the goods, which gives them enormous leverage. If you don't pay me, I don't deliver the wheat you need to run your factory. And now they control the financial flow, too.
The report has this really stark comparison between the traditional bank-mediated model and this new trader-intermediated structured finance model. In the old days, the bank was the one assessing the risk of the final buyer.
Correct. The bank's credit risk officer would look at the buyer's balance sheet, their payment history, all of it. Now, the bank just cuts a massive check to the trader. The trader handles all the risk, the complex financing terms, the derivatives. The bank has effectively outsourced the entire banking function to the food company.
It sounds efficient in a very ruthless sort of way. I mean, the banks get to lend huge amounts of money without the regulatory headache, and the traders get a massive new revenue stream. But it also sounds like the traders are holding all the power now.
They are holding the cards, the chips, and the table. And this brings us to the next part of the report, the mechanics of how they actually generate that 76% of their revenue. Because it's not just charging simple interest on a loan, it's much, much more sophisticated than that. The report dives deep into something called structured finance.
Structured finance.
Oh, okay.
That is one of those terms that is just designed to make normal people's eyes glaze over and stop asking questions.
It is. It's intentionally opaque.
But we are going to ask, what is actually happening here? Break it down for us.
Okay, think of it this way. In the old model, if I sold you wheat and you said, I'll pay you in 90 days, I held an IOU from you. In accounting terms, that's called a trade receivable. It's an asset that sits on my books. I just have to wait 90 days for your cash.
Right. Simple that.
In structured finance, I don't just sit on that IOU. I take your IOU and I bundle it together with thousands of other IOUs from other buyers in other countries. I turn that big bundle into a brand new financial asset, a security, and then I sell that security to investors in the capital markets.
Wait a second. This sounds incredibly familiar. This is securitization. This is exactly what Wall Street did with home mortgages before 2008. They bundled thousands of individual mortgages into bonds and sold them to investors all over the world.
The mechanism is almost identical. The report highlights a fascinating case study of Bungie to illustrate this exact shift. Before 2010, pre-Basel, the Bungie securitized less than 10% of its receivables. They mostly just held the debt on their own books.
And after the new regulations kicked in.
After they implemented new securitization programs in 2011, that number shot straight up. By 2024, the report shows that at least 6 of the top 11 global food traders are heavily using securitization. They're taking the debt owed by food buyers around the world, packaging it up, and selling it off to pension funds, insurance companies, and hedge funds.
So why do they do this? Is it just to get the cash faster instead of waiting 90 days?
That's a big part of it, yes. It creates immediate liquidity for them to go out and do more deals. But the deeper, more strategic reason is that it decouples the risk.
What does that mean, decouples the risk?
In the old days, a bank cared deeply about the creditworthiness of the specific baker in Cairo who was buying the wheat. Their money was on the line. Now, through securitization, the trader is selling a product that's backed by a diversified flow of cash from thousands of buyers. They are selling the stream of money to investors who might know absolutely nothing about agriculture.
So a teacher's pension fund in Ontario might be buying a bond that is, in reality, backed by the promise of a flour mill in Cairo to pay for a shipment of wheat.
Exactly. And the pension fund manager, they don't see the flour mill. They just see a Bungie securitized note with a AAA or BBB credit rating attached to it. It's an abstraction.
It effectively hides the underlying risk, or at least spreads it out so thinly that it seems to disappear.
Precisely.
But there's another layer here that I found even more complex and, frankly, more concerning. The report talks about embedded derivatives. Now, I know what a normal derivative is. It's basically a bet on the future price of something. Farmers use them all the time to hedge, to lock in a price, and protect against prices dropping.
Right. A standard derivative is a form of insurance. I'm worried the price of corn will drop to $3 by harvest time, so I'll buy a contract today that pays me if it does. That's a healthy, risk-mitigating use of derivatives.
But embedded derivatives sounds like something else entirely.
It is. These traders are now designing incredibly complex sales contracts with their buyers that have these derivative structures built inside the contract itself. They are creating, essentially, financial algorithms that are designed to profit specifically from volatility. The report calls it volatility arbitrage.
Volatility arbitrage. Okay, so they aren't just betting on the price of wheat going up or down. They are betting on the market just going crazy.
They are monetizing the chaos. That's the best way to put it. Let me try and give you a simplified example. Let's say a trader signs a contract with a developing nation's government to supply 1 million tons of grain over the next year.
Okay.
Within that contract, they might embed a clause or a derivative structure that adjusts the final payment based on, say, extreme currency fluctuations, or a sudden spike in shipping insurance costs, or even certain defined weather events.
So on the surface, it looks like they are just protecting themselves from unforeseen events.
That's how it's presented. But the report suggests it goes far beyond simple protection. It talks about creating asymmetric returns.
Asymmetric returns.
It means the contract is designed so that if the market stays calm and predictable, the trader makes a standard, respectable profit. But if the market explodes, if there's a war, a massive drought, a currency collapse, the trader makes an absolute windfall.
They win when the world loses.
Essentially, yes. They have positioned themselves to benefit financially from instability in the food system.
Which brings us back to the profit data we discussed earlier. It explains everything. Even when food prices fell from their 2022 peaks, the volatility in the market remained incredibly high because of geopolitical tension and climate uncertainty, so they kept making record profits.
They have moved beyond just selling food. They are selling exposure to the food market's behavior. They are selling the risk itself as a product.
This brings us to the part of the report that, I have to be honest, unsettled me the most. It challenges the one thing we assume these giant monolithic companies have in abundance: money. The report calls it the liquidity illusion.
This is a crucial concept, and it's where the shadow banking analogy becomes very real. From the outside, ADM, Cargill, Glencore, they look like fortresses.
Yeah.
They have billions and billions in revenue. You just assume they are swimming in cash.
Of course, they are the definition of too big to fail. You look at their annual reports, you see a line item for available liquidity that's in the tens of billions of dollars, and you think, okay, they're safe. They can weather any storm.
But the report acts like a forensic accountant here. It peels back the curtain and asks the simple, devastating question, what is that liquidity actually made of?
And the answer is, it's mostly just a credit card limit.
It is debt they haven't used yet. The report uses Archer Daniels Midland ADM as a specific and quite shocking case study analyzing their 2023 financial disclosures. It's a perfect illustration of this illusion.
Let's walk through the math on this, because I think this is where the shadow bank reality really hits home for the listener.
Okay, so in 2023, ADM reported $12.9 billion in total available liquidity.
$12.9 billion.
Right, so if you're an investor, a regulator, a journalist, you see that number and you sleep well at night. You think, that's a huge war chest.
Absolutely.
But let's break it down the way the report does. Of that $12.9 billion, how much of it was actual cash? Money sitting in a bank account that they could spend tomorrow.
The report says $1.4 billion.
Just $1.4 billion. That's only about 10% of their stated liquidity. But wait, it gets even tighter than that.
How does it get any tighter? Cash is cash, right? If it's in the bank, I can spend it.
Not in the complex world of multinational tax avoidance. The report notes that of that $1.4 billion in cash, $500 million of it is held in foreign subsidiaries. It's essentially trapped offshore.
Trapped? What do you mean by trapped?
Effectively, yes. If they try to bring that money back to the headquarters in the U.S. to use it for a crisis, they would likely trigger a massive tax bill. And multinational corporations hate doing that more than anything, so they just leave it there. They call it indefinitely reinvested.
So the real, immediately available, no-strings-attached cash to run this massive global operation is only about $900 million.
$900 million.
Okay, hold on. This is staggering. They claim $12.9 billion in liquidity. But in a real, I need money right now to make payroll and buy grain emergency, they have less than $1 billion. Where in the world is the other $11.5 billion coming from?
Unused lines of credit.
So it is a credit card. It's just a giant corporate credit card.
That's all it is. 89% of their liquidity is nothing more than a promise from a syndicate of banks that they can borrow money if they need to. It's not cash they have, it's cash they could have, assuming the banks agree to give it to them when they ask.
And this leads directly to the run on the shadow bank scenario that the report describes so vividly.
Exactly. Imagine a financial crisis hits. Not a food crisis, but a broad banking crisis. Think another 2008, or even a smaller shock like the Silicon Valley Bank collapse. Banks get scared. They need to hoard capital and shore up their own balance sheets. What is the very first thing they do in a panic?
They stop lending. They freeze credit lines.
They cut up the credit cards overnight. That $11.5 billion in liquidity on ADM's books evaporates. It's gone. It was never really there.
And the trader. They need that credit every single day to buy the grain from the farmers, to pay for the fuel for the ships, to insure the cargo. Without it,
they freeze. The entire operation grinds to a halt. They become insolvent very, very quickly because their whole business model is operating on this illusion of liquidity.
This is terrifying. I mean, we aren't talking about the supply of, say, designer handbags here. If the company Hermes runs out of liquidity, well, people just don't get new Birkin bags for a while. If these guys freeze, the wheat doesn't leave the silo in Kansas. The soy doesn't get loaded onto the ship in Brazil.
And that is the very definition of procyclicality. It's a fancy economic term that just means making a bad situation worse. In a crisis, you want some parts of the economy to be stable, to act as shock absorbers. But this system is the opposite. The traders are completely dependent on the very banks that are most likely to be in trouble during a financial crisis. So instead of absorbing the shock, they amplify it and transmit it directly into the physical food supply chain.
And speaking of that trapped cash offshore, the report mentions something else called undistributed earnings. This sounded like another one of those accounting tricks to obscure the real financial picture.
It is, and it's a huge piece of the puzzle. It's all about where the profit lives after it's been made. The report points out that companies like Cargill and ADM keep these enormous piles of profit, we're talking billions and billions of dollars, in their offshore subsidiaries. On the books, these are listed as being indefinitely reinvested abroad.
The report had a great line for this. It said they are trading their cake and keeping it too.
That's a perfect way to put it. They extract the profit from the global system, from the farmers who grow the food, from the consumers who buy it, but they lock that value away in low-tax jurisdictions like Switzerland or Singapore. So if there's a liquidity crunch in their home market, say in the US or Europe where their main operations are financed, that capital isn't there to save them.
It's sitting in a tax haven.
It's effectively useless for immediate crisis management. It's built for tax efficiency, not for resilience.
So we have a system where the companies responsible for feeding the entire planet are pretending to be liquid, but are actually just maxing out their credit lines, while simultaneously hiding their actual profits in places where they can't be easily touched in an emergency.
That is a very fair and accurate summary of the report's findings. And it brings us to the final and perhaps the most complex and scary risk factor. The report calls it the spider web.
This is the section on systemic contagion.
Yes. We tend to think of risk in neat little silos. If ADM fails, that's ADM's problem. But the report's key argument here is that this is a contagion architecture that spans at least 80 countries. These companies are not islands. They are deeply, deeply interconnected with the entire global financial system.
The report mentions they operate through literally thousands of subsidiaries and joint ventures. I knew these companies were big, but the sheer scale of the corporate structure is just wild.
Glencore is a great example they use. Glencore isn't really one company. It's a sprawling network of hundreds and hundreds of subsidiaries, joint ventures, and special purpose vehicles. Now, why does this matter for systemic risk?
Okay, why?
Imagine you're a major global bank.
Yeah.
Your corporate lending division lends, say, $1 billion to Glencore headquarters in Switzerland.
Right, a single loan.
But your bank also has a project finance division that lends money to a copper mine in Peru, and another division in your asset management arm that buys securities issued by a port operator in Rotterdam. You look at your books and you think you have a nicely diversified portfolio. I'm lending to trading, mining, and shipping. 3 different sectors.
But it turns out the mine in Peru is a Glencore joint venture, and the port in Rotterdam is a wholly owned Glencore subsidiary.
Exactly. You have these hidden connections. You thought you had 3 separate, unrelated risks. In reality, it's all the same risk. If the parent company in Switzerland takes a massive hit on an oil trade, or if that copper mine collapses, the financial distress travels through the entire web almost instantly. It's a massive blind spot for regulators and for the banks themselves.
The report talks about something called a counterparty exposure index. That sounds like they actually tried to map this incredibly complicated mess.
They did. And the analysis shows that the distress can travel in 2 directions. We've talked a lot about how a banking crisis can hurt the trader, but it can also travel the other way, from the food trader out into the physical economy.
Right. So if the trader crashes because of a bad derivatives bet, the farmer in Nigeria or Indonesia doesn't get paid for their crop. The shipment of wheat that Ukraine was counting on doesn't happen.
And we are seeing that the financial stability of local food supplies in dozens of developing nations is now directly tied to the balance sheets and financial acumen of these few, largely unregulated traders. If a trader makes a bad bet in Chicago, a flour mill in Indonesia might have to shut down because the trader loses the liquidity to execute the physical deal. The connection is direct.
This sounds dangerously, almost exactly like the too big to fail problem we had with the banks back in 2008.
It is too big to fail, but with a terrifying twist. They are not regulated like banks. There is no Federal Reserve or European Central Bank looking over their shoulder, mandating capital ratios and conducting stress tests in the same way. If one of them fails, there is no established bailout mechanism. There is no FDIC for food.
And unlike a bank failing, where maybe the ATMs stop working for a weekend and it's a huge inconvenience.
If these guys fail, the physical movement of calories across the planet stops. It's not an inconvenience, it's a humanitarian catastrophe.
That is the nightmare scenario. It just forces you to ask, is all this so-called efficiency worth this kind of risk?
Well, the report challenges the very idea of efficiency. We're constantly told that this modern financialized system is efficient, it lowers costs, it moves goods faster, and on paper in the good times it does. But the report suggests that this efficiency is actually just a mask for extreme fragility.
We've built a race car that goes incredibly fast on a smooth track, but if it hits a single pebble on the road, the whole thing just explodes.
That is a perfect analogy. We have built a system where the very companies responsible for feeding us are incentivized to profit from volatility rather than from stability. Think about that for a moment.
Right.
If they make more money when the market is chaotic, through those embedded derivatives in their volatility arbitrage strategies, do they have any real incentive to make the market stable and predictable?
That is the provocative thought I think we need to leave our listeners with today. We all just assume that food companies want a stable, predictable food supply. But if they are actually shadow banks in disguise, They might just want a volatile market that they can trade against.
It creates a deeply perverse incentive structure at the heart of our food system.
Yeah.
And until we recognize that, until we start regulating them like the systemically important financial institutions they have clearly become, we are, I think, living on borrowed time.
So let's just quickly recap the incredible journey we took today. We started with a simple image of a truck on a dusty road, thinking it was just agriculture.
And we discovered it was actually a financial instrument. We learned that the ABCD giants have completely shifted their identity, deriving on average 76% of their revenue from financial activities rather than from physically moving food.
We then learned that Basel III banking regulations inadvertently pushed the traditional banks out of trade finance, which allowed these traders to step in and become enormous, unregulated shadow banks using what's called synthetic banking.
We unpacked the mechanics of how they do it. Securitization that bundles up and hides risk, and embedded derivatives that allow these traders to profit directly from chaos and volatility.
Then we exposed the liquidity illusion, the shocking fact that their billions in reported cash are mostly just unused credit card lines that can be canceled in a crisis, leaving them high and dry.
And finally, we looked at the spider web of contagion, the hidden connections across 80 countries that mean a failure in one part of the shadow banking system could ripple outwards and threaten to shut down the global food supply.
So for the person listening to this right now, maybe they are driving to work, maybe they are making dinner, why does this abstract financial stuff matter to them personally?
It matters because the price of their groceries is no longer just about the weather in Kansas or a drought in Brazil. The price, and even more importantly, the availability of food, are now directly linked to complex financial derivatives and the stability of shadow banks they've never heard of.
The financialization of food means that food prices now reflect financial strategies, not just harvest yields.
Exactly. When you go to the supermarket and buy a loaf of bread, you are paying for the wheat, yes, but you are also paying for the cost of the securitization program, the risk premiums, and the volatility arbitrage strategies of a company in Geneva. You are, in effect, paying a finance tax on your lunch.
That is a very sobering thought.
Yeah.
It makes you look at the supermarket shelves in a completely different light.
It should. It's a call to look at the fine print of the global economy, because that fine print is, quite literally, what's for dinner.
This report, the Trade and Development Report 2025, is a dense read, no doubt about it. But it's a warning flare. It's telling us that we have, without really noticing, allowed the fundamental architecture of our survival to be turned into a casino.
And in a casino, the house always wins. The question is, can we afford to keep playing this game?
A question for the regulators, and I think for all of us. Thanks for diving deep with us today. This has been a real eye-opener.
Always a pleasure to unpack the complexity.
And to you, listening, the next time you see a truck full of grain on the highway, remember, it might just be a bank on wheels. Keep asking questions. We'll see you on the next deep dive.